Should your retirement paycheck come from dividends, an insurance company, or a mix of both? If you're 50 or older, you've probably heard the passionate arguments from all sides. One is, just live off of dividends. The other, you need a guaranteed income from an annuity. And then finally, never buy an annuity. In this video, I'm going to walk through the trade-offs in plain English and show you exactly how I think about dividend paychecks versus annuity paychecks when I build a real retirement plan. Hi, I'm Zach. I'm a fiduciary advisor, and I help people 50 years and older turn their savings into a durable, understandable retirement income plan that minimizes taxes. Now let's define terms so that we're on the same page. What is a dividend paycheck? This is when you own a portfolio of dividend-paying stocks or funds, and the companies send you cash, typically every quarter. Your paycheck is the dividend income that those investments generate. The underlying stock prices can go up and down, but the goal is a growing stream of dividend income over time. Now, what is an annuity paycheck? This is when you give a lump sum to an insurance company in a fixed or fixed index annuity, and in return, they either credit interest or in some contracts, they send you a steady stream of income based on the contract rules. Your paycheck is governed by the annuity contract and oftentimes creates a guaranteed lifetime income, much like a pension would. The value doesn't bounce around every day like a stock or bond fund, and as long as you follow the rules, you're all set. Both of these tools, both of them can fund retirement. They just do it in very different ways. Now let's start with why I love dividend income as a core engine for retirement paychecks. A dividend portfolio can provide a rising income potential. You see, good dividend growth companies aim to increase their dividend payouts over time. And what this means is that your income can grow faster than inflation if the strategy is executed well. Now, dividend stocks also provide liquidity and flexibility. You own these liquid securities directly. If you need to raise cash, you're not stuck behind surrender schedules. You can usually sell and adjust as life changes. Further, dividends can provide preferable tax treatment. You see, in taxable accounts, qualified dividends and long-term capital gains often get a more favorable tax rate than ordinary income. That can mean more net after-tax dollars in your pocket for the same gross income. And then finally, let's talk about legacy and control. With a dividend portfolio, whatever you don't spend is generally available to your heirs, and they've also inherited a cash-generating machine. Now, for retirees who value that increasing or rising income, value flexibility, and the benefits of the legacy, dividends often make a fantastic backbone for retirement paychecks. So what about annuities? Now, before I go on, I want to make it very clear that I'm talking about fixed and fixed index annuities used as a safety net, not complicated high-fee products like variable annuities. Now, first, annuities can create a floor of income or principal protection that does not depend on daily market movements. For some people, just knowing this base level is safe is worth quite a lot. Then annuities provide behavioral control. When part of your income is contract-based rather than market-based, it can help you stay calmer during volatility. You're less likely to panic sell your investments because you know the bills are covered. In addition, annuities address longevity risk. Some annuities can guarantee a paycheck for as long as you live. If you have a history of longevity in your family and you're worried about outliving your money, that longevity insurance can be quite valuable. Finally, annuities can be a bond replacement for some retirees. You see, bonds, they can lose value when interest rates go up, while fixed and fixed index annuities, they don't show the same daily price decline on a statement. What you're doing is you're trading market price risk for contract rules and surrender terms. So annuities tend to shine when the top goals are having a stable income floor and you don't want to lose your principal. In addition, you want peace of mind and longevity protection. Okay, so let's talk about how we might allocate annuities and dividends in a portfolio. To be fully transparent, most real-world plans I build, they don't use all dividends or all annuities. Here are 3 simplified examples. This is not advice, just illustrations. The first example is for someone who I would call the worried spender. In this case, we would use 40 to maybe 50% in the safety bucket using fixed or fixed index annuities and short-term cash reserves. Then 50 to 60% of the portfolio would go into dividend growth and traditional investments. This works well for someone who has enough saved but is anxious about market drops and wants a very clear and guaranteed income floor. Now, the next example is what I call the overfunded, market-comfortable retiree. For this situation, we might not use any annuities at all. If we do, we would max out at around 20% to replace bonds. So we'd be using 0 to 20% in annuities or bonds, and then 80 to 100% in dividend growth and diversified stock portfolios. This type of person would have a sizable retirement portfolio, and they would be really comfortable with volatility. So we rely mainly on dividend income and portfolio withdrawals with a small stability bucket. And finally, we have what we call the late saver or the single with no pension. In this situation, we'd look at about 30 to 40% into an annuity to cover non-negotiable expenses, and then 60 to 70% in dividend growth and diversified investments for growth and extra income. Here, the annuity is used as a bond replacement and income floor, and the dividend side handles inflation and lifestyle upsides. The exact percentages depend on your specific number, your nerves, and your goals, but the pattern is the same. First, build the income floor, then layer on growth. Now, when it comes to building a plan, here's the order of operations that I use. First, I figure out your income floor. What does it cost to live your life comfortably, but not lavishly? And how much of that is already covered by Social Security and any pensions? Then, if there's a gap, decide how to cover the gap. Do we do that with dividend income alone, or do we want some of it contractually protected by an annuity? Then lastly, we look at layering on growth and optionality. Once we get above the income floor, we can focus on dividend growth, total return, and tax efficiency. That's where you get raises over time and protect your purchasing power. We always fit the tools to the person. If you value flexibility and legacy above all, we lean more into dividends. If you value certainty and sleep at night above all, we lean more into the annuity bond-like safety. Many people end up in the middle. Dividends and annuities, they're not enemies, they're just different tools for different jobs. So if you're listening and watching to this thinking, I get the theory, but I still don't know what mix fits me. Well, that's exactly what we help people figure out during our first meeting. If you'd like to see a side-by-side dividend versus annuity income plan for your specific situation, we could run your numbers both ways and compare them in black and white. You can find a link below this video in the description, and you can schedule a time to talk to see if you might want to compare dividends versus annuities. If you're not quite ready to talk, you might be interested in our free retirement masterclass, to which you'll also find in a link below this video. Whatever you decide, don't let product marketing make this choice for you. Start with the paycheck that you need, then choose the right combination of tools to deliver it. Now, I have a disclosure. This video is for educational purposes only. This is not financial nor tax advice. Please talk to a licensed professional such as myself before making any investment decisions. Any guarantees mentioned in this video, they're based on the claims paying ability of the insurance carrier. If you like this content, please like and subscribe. and we'll see you in the next video.